In this lecture example, we look at the Woulidge principle. Now, just important again is the Woulidge principle quite often poses a bit of a challenge to students, but I want you to remember and understand that the majority of the time this cannot count a lot of marks, because then the question stops being about trust or tax and it starts being about just the Woulidge principle. So there might be some marks there, but I don't believe that this is the end of the world. You should never be able to fail a question just because of the Woulidge principle. Okay, so guys, your rules around section 25b and section 7 and paragraphs 68 to 72, the CGT implications, those things are a lot more important. Okay, so, but let's talk about this. So Mr. X owned a block of flats with a market value of 2 million rands. He transferred the block of flats to the ABC Trust. The block of flats earns rental income of 300,000 for the period after it was sold. In terms of the trust deed, Mr. X's minor son has a vested right to all of the rental income that is distributed to him. Now, what does this mean? So this distributed to the minor son. This means that section 7.3 will apply if there is a donation. So remember, it only applies if there's a donation. So let's look at the first one. A. Mr. X sold a block of flats to the trust at its market value and was paid immediately. In that case, there is no donation. So who should be taxed on that 300,000 rands that goes to his son? So we'll ask the question, was there a donation? Is the donor alive? No. Okay, so section 25b applies. Section 25b says whoever has a vested right should be taxed on it. In situation A, the minor son will be taxed on that 300,000 rands. Situation B, Mr. X donated the block of flats to the trust. So now this is a full donation, not an interest-free loan. If this is a donation, section 7.3 will apply. So was there donation? Is the donor alive? Yes. Does any of the section 7s apply? Yes. Section 7.3 does. Who should be taxed? The donor should be taxed. So in situation B, Mr. X will be taxed. C, Mr. X sold a block of flats to the trust at its market value on an interest-free loan. A market-related interest rate is 10%. You may assume that the flats are sold on the first day of the tax year. Now, what is important here is that you see that they tell you that it was sold at market value, but it's on an interest-free loan. The fact that it's an interest-free loan is a problem. So now we have to apply the Woulidge principle. So what you need to understand about the Woulidge principle, let's actually not call it the Woulidge principle. I'm going to call it the Woulidge limit. So the Woulidge limit says the maximum amount that you can be taxed on. So what you need to do is you need to calculate what is the you need to calculate the following. You need to say, what is the market-related interest for the period? So what you're trying to say is you're saying, if they charged the correct interest, how much would they have charged? Now, he sold the block of flats for 2 million rands. That is the value, and the interest rate is 10%. So if he had charged the correct interest, it would have been 2 million times 10% times 365 days over 365 days. So 200,000 rands. Less the actual interest charged. Okay, so we're trying to figure out how much interest did they not charge. They didn't charge any interest. So how much interest did they not charge? 200,000 rands. Now what you need to understand about that, the 200,000 over there, is that that is the maximum amount that Mr. X, the donor, can be taxed on in terms of section 7. Okay, so just to show you guys, here's that calculation in your solution. So what it means is, I want you to now see and make sure that you understand. This 300,000 rands is supposed to go to his son. We saw that it is subject to section 7.3. That is what we saw in part B, where Mr. X was taxed on it. Right, the difference between B and C is that in B, it was a full donation, and in C, it's just a donation of interest. So what I want you to understand is that, although 300,000 rands should be taxed in the hands of the donor cannot be taxed on more than 200,000 rands. That's the limit. So, 300,000 rands, that's 300,000 rands, and I'm talking about this 300,000 that goes to the child. That 300,000 rands is then going to be split as follows. 200,000 of that will be taxed in terms of section 7.3, and 100,000 of that is treated as if there was no donation, which means Section 25B applies. So understand, you can only apply the Section 7 rules to the amount of the limit. So, 200,000 rands will be taxed in the hands of Mr. X. And for the 100,000 rands that remains, you'll say, was there donation as a donor or life? No. So who has a vested right? The son. So the son is taxed. Right. So here's C. Here's the calculation. 200,000 rands for Mr. X. For the minor's son, 100,000 rands. Okay, then the next one, all I'm just trying to show here is he sold the block of flats to the trust at its market value on interest-free loan, and it was sold on the 1st of September. So the difference is that you had it for September to February. So September, October, November, December, January, February. It's 181 days. So the only difference would be is that when you are doing your Woulidge limit, instead of saying times 365 over 365, you'd say times 181 over 365. Right, which would make the Woulidge limit 99178. So now it's the same story. There was 300,000 rands distributed. 99178 will be subject to Section 7.3, and the remaining amount 266,822, that will be no donation, so you would have to consider Section 25B. Okay, so that's for part D, for donkey. Let's go see. There we go. All right, there we go. Okay, this is me miscalculated there. It should be 208.22. All right. Then E, Mr. X sold a block of flats to the trust at its market value and charged 2% on the outstanding loan. A market-related interest is 10%. You may assume that the flats were sold on the first day of the tax year. Okay, now this is a little bit more challenging. Okay, so let me just take us a little bit down. So the first thing that you're going to see is the market related interest. Again, this is the interest that you should have charged, which would have been 2 million rands times 10% times 365 over 365. Right? Less interest charge. So this is less the actual interest. Now in this case, they tell you that you charged 2% interest. Okay, so that gives us our Woulidge limit of 160,000 rands. Okay, so I just want you to see in your solution. That's 160,000 rands. Now comes the more challenging part. So what I want you to see is what we've done here is we've identified, and you will always have to do this, how much of this distribution, so in this case we only have one, goes to the child, and that is this whole 300,000 rands. But now I want you to understand that there was market interest is 10%, and the actual interest is 2%. So that means the donated interest is the difference there, right, of 8%. So what I want you to understand is that you said if the market interest is 10%, we actually did charge 2%. So 2 out of the 10 is not a donation, but 8 out of the 10 is a donation. So what I want you to see, and this is the challenging part, because this is when you have to get your head around that, is understand that if 10% is the market-related interest and we've only charged 2%, then it means we've charged 20%, 2 out of 10, of the correct, 2 out of 10 is not a donation. So what that means is that this 300,000 rands, we can split. We say 300 times 2 over 10, 60,000. And we say 300 times 8 over 10, 240. Okay, now what it means is, it means that 300,000 rands, only 8 out of 10, 240,000 of that, will be subject to section 7.3. That's the portion that is a donation. And this is what I'm saying to you guys also, that I mentioned in the beginning of this lecture example. This is what students quite often struggle with. Very seldom that this is taxed and tested in this way. Right, so 2 out of 10 is not a donation, 8 out of 10 is a donation. So this 240,000 rands is the amount that the donor can be taxed on under section 7.3, 240,000. But what is the issue? We just calculated that the Woulidge limit is 160,000 rands. So we are saying of that 300,000, the donor can only be taxed on a maximum of 160,000, leaving 140,000. So that 160,000 rands, that is the amount that Mr. X will be taxed on. And 140,000 rands is what his son will be taxed on. Okay, so now we have the same type of situation, guys, but the big difference is now we have more than one beneficiary and more than one section 7. Okay, so this is a little bit more challenging, and it is again not common to see this. So Mr. Y transferred a block of flats to the ABC Trust when the market value of the flats was 2 million rands. After being transferred to the trust, the block of flats generated 300,000 rands. In terms of the trust agreement, 100,000 rands is to be distributed to each of Mr. Y's 2 minor children, child A and child B. So I want you to understand, so that will be subject to section 7.3. And no one has a vested right to any income that is retained in the trust. Right, so what does that mean for us from your studies? It means section 7.5. So this 300,000 rands over there, 100 and 100 and 100, can be taxed in the hands of Mr. X. So let's see the situation. First up, what happens if he sold the block of flats to the trust at its market value? If he sold it to the block of flats at its market value, then there is no donation. So we ask ourselves, was there a donation as the donor life? No. So we have to look at section 25B. That one says the person with a vested right will be taxed on it. So that means child A will be taxed on 100,000, child B will be taxed on 100,000. The income which is retained in the trust, no one has a vested right to it, it has not been paid out, so then the trust will be taxed on that. So that's your normal rules. So child A, child B, the trust. Okay, so this, if you did not get this 100% correct, then you're not struggling with the Woulidge principle, then you are struggling with the principle around trust, and you should stop right now and go back. Right, what happens if Mr. Y donated the block of flats to the trust? If he donated it to the trust, then he's going to be taxed on all of these amounts. Right, so there's child A, 100,000. So you see this is Mr. Y. He's getting taxed on it. Child B, and the undistributed income. C, what happens if he did not charge any interest and a market-related interest is 10%? So he sold it on an interest-free loan. So market interest, 2 million times 10% times 365 over 365. Actual interest, null. Okay, so 200,000 rands. So this is our Woulidge limit. Okay, so now you need to make sure that you see. So in part C, he sold it at a loan, didn't charge interest. We say the maximum that you can be taxed on is 200,000 rands. What did we see in situation B when it was a donation? We saw that 100 and 100 and 100, so a total of 300,000 rands is subject to section 7, and which Mr. X can be taxed on. But now we've calculated that it can only be taxed on a maximum of 200,000 rands. So how is that going to work? Okay, so I want you to see here, we've got child A, child B, and the trust. What you need to do is you need to identify what are the amounts which will be subject to Section 7? And in this case, for child A, B, and undistributed income, it's 100,000 rands each. So I'm going to write here, this over here is the all amounts subject to Section 7. So what I want you to see is, there is an amount of 300,000 rands available that should be subject to Section 7, but only 200,000 rands of that is allowed. So, how much of the 100,000 rands can this donor, Mr. Y, be taxed on? How much of the 100,000 for child A, for child B, and for the trust? How much can he do it? So, how are we going to figure that out, guys? It's very, very simple. Right, it's very simple once you understand it. But it'll be is, you take these amounts, and you say, the donor can be taxed on 200,000 out of the total 300,000 that is subject to Section 7. So we are just apportioning it. Right, so it means 66666. Right, so just a little bit of rounding. If you add all of that up, you will see that the total comes back down to 200,000. So, of child A, 100,000 rands, Mr. Y, the donor, can be taxed on 66,666. So, if I take you now to C, make sure that you see, Mr. Y, he gets taxed on, right, so that was just from the rounding, guys, there, but there you go. So each child and the trust is then taxed on 100,000 minus 66, so the remaining portion. Right, and then D, Mr. Y sold the block of flats to the trust at its market value and charged 2% interest on the outstanding amount. And, right, market rate interest is 10%. Now guys, this is a little bit more challenging, so this is probably the most challenging that you can find it. But again, if you understand what we've been doing up to now, it's very logical. Alright, so let's do this. So the actual interest that he should have charged is 2 million times 10% times 365 over 365. He actually charged 2 million times 2% times 365 over 365. So he charged 40,000. So that means that the Woulidge limit is 160,000. Okay, so now I'll just make sure that you see. Alright, so now we're trying to say how much of these amounts are subject to Section 7. But now you have to remember again, we've got that same situation where the interest is 10%, 2% is not donation, and 8% of that is a donation. So the first thing that you need to see is that all of these amounts that goes to the children, we need to apportion, we need to say times 8 over 10. So we're calculating which amount of this over here, this is amounts subject to Section 7. So this is what the donor could be taxed on. However, we can see that the donor can be taxed on a maximum of 160,000. So we're going to have our same situation as in the previous one. So you can see, guys, the only difference is from this and the previous one is that we have this extra step in here. So child A, child B, and the trust. What is the amount subject to donations? The 80 over there. How much can it be taxed on? 160. What's the total that's subject to Section 7? 240. So we will apportion 160 Right, so 53333. And if you add all of that up, again just a little bit of rounding, but if you add all of it up, it gets back to 160,000, which is the maximum. So the donor will be taxed on 53,333 in all situations. Right, so here's Mr. Y. Right, here's Mr. Y. 53,333 for all of them. And then each of those other people, child A, child B in the trust, they'll be taxed on their amount minus the amount that was gone to the donor. Alright guys, that's the most complicated one. Then example 3, a little bit quicker. Mr. X sold a block of flats to a trust on the 1st of March 20x5 for a market value of 10 million. He did not charge any interest. In terms of the trust deed, each child has a vested right to 45% of the rental income. The remaining 10% must be retained in the trust and no person has a vested right to it. Child A is 23, child B is 14. So child B is a minor. Right, so child B will be subject to section 7.3, retained in the trust, section 7.5. So I want you to see they give you for 20x5 and 20x6, okay? Then they tell you, calculate the taxable income for all the persons noted in the question for the 20x5 year of assessment. Alright, so guys, the moment that you see there's a loan in there, we have to do the Woulidge limit. So the market interest that should have been charged is 10 million rands times 10%, and it was for the year, I believe. Right, so 1 million rands is the Woulidge limit in the 20x5 year. Now I want you to see in the 20x5 year, what are the amounts subject to section 7? It is the 360,000 and the 80,000. Are you happy? So subject to section 7, child B 360,000 and the trust 80,000. Child B section 7.3, trust section 7.5. Right, so this is 440,000. What is our limit? Our limit is 1 million. We've used up 440,000. So in other words, in 20x5, the donor can be taxed on those amounts. There we go. Right. Child A was not a minor. Child A gets taxed on his own amount. There we go. Now I want you to see, this is what the principle is that they're trying to establish here. In 20x5, we had 1 million rands as our Woulidge limit. So the market-related interest was 1 million. The actual interest that was charged was 0. So we had a Woulidge limit of 1 million rands in 20x5. We used 440,000 of that. So I want you to make sure that you understand the principle here. Is that there is 560,000 rands that will be carried forward. Because remember, the Woulidge limit says the total interest that you have not been charged at over the entire period of this loan. So watch now what happens in 20x6. In 20x6, we have to calculate our Woulidge limit. Remember, the interest rate could change every year, so every year you have to do this. The market interest, 10 million times 10% times 365 over 365 is 1 million. The actual interest that was paid is 0, plus then carried forward from prior year, because this is an amount of interest that we have not been taxed on. So basically what they're trying to say is you can't, we will keep on adding up all of the interest that you've incurred. We will keep on adding all of that up So if over 10 years, you will have 10 years of interest that you could be taxed on if you haven't used it up at all, if you haven't been taxed on it yet. So in 20x5, look at the distributions. Child A will be taxed in terms of section 25B. Child B is a minor, will be taxed in terms of section 7.3 and retained in the trust section 7.5. So see now these amounts. I'm going to write it down. Subject to section 7. Child B, 1125. The trust, 250. So 1375. That is the total amount subject to section 7. What is our limit now? 1440. And can you see what happens here? If you had said the limit is just R1,000,000, this would have been too much. Now it's not. It's 1440. So these two full amounts can be taxed in the hands of Mr. Y, the donor. Right, I think I might have just... No. Right, and child A, tax on his own, in terms of section 25B, and the trust and child B are not. And that is the Woulidge limit, guys. So, like I said, it's a principle that you have to understand there. Please do work for these questions, but it should not be the end of the world.